Ladies and gentlemen, good day and welcome to Varroc Engineering Limited Q3 FY24 earnings conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashin Modi from Equirus Securities. Thank you, and over to you, sir.
Thanks, Manav. Good evening, all participants. Thanks to Varroc Engineering Management for giving us the opportunity to host the call. We have with us the senior management represented by Mr. Tarang Jain, Chairman and Managing Director, Mr. Arjun Jain, Full-time Director and CEO of PTI, Mr. Mahendra Kumar Karumanchi, Group CFO, and Mr. Vikas Dugar, Head Investor Relations. So I would now like to hand over the call to Tarang sir for his initial opening remarks. Over to you, sir.
Thank you, Team Equirus, for hosting the call, and good evening to everyone for joining the call. Starting with the current macroeconomic situation, the Indian economy continues to sustain its growth momentum with a GDP growth of 7.6% in Q2 FY24, exceeding market expectation. The automobile production in India during Q3 FY24 grew on a year-on-year basis for all the segments. Passenger vehicles grew by 5%, commercial vehicles grew by 5.9%, whereas the three-wheeler and two-wheeler segments registered strong growth of 13.4% and 19% respectively. This growth was due to the strong economy and the late festive season this year. Sequentially, that is quarter on quarter, we have seen degrowth in all the segments. Commercial vehicles have degrown by 8.3%, passenger vehicles by 10.9%, three-wheelers by 8.9%, and the two-wheeler saw a degrowth of 1.5%. The degrowth on a quarter-on-quarter basis seems to be mainly due to the year-end phenomenon. Our operations in Q3 of FY24 mirrored the industry situation. Our revenue in India grew by 20.1%, which is higher than both two-wheeler and passenger vehicle industry growth on a year-on-year basis. However, revenue from our overseas operations had a degrowth as two-wheeler production levels went down in certain markets like Vietnam and Italy. In addition, our customer concentration in these markets impacted our revenue. As we look forward in our overseas business, our focus is to drive customer diversification in the order book and hence mitigate our customer concentration risk. We also drive cost actions through insourcing and working capital optimization. These efforts are likely to lead to a gradual recovery in the overseas markets and improve financial performance in the medium term. Despite degrowth in the overseas markets in Q3, the overall revenue from operations grew by 9% on a year-on-year basis to rupees 18,846 million. The reported PBT for the quarter was rupees 708 million, which includes profit from a joint venture of rupees 250.7 million. The PBT margin improved by 300 basis points on a year-on-year basis and came in at 3.7%. Last year, we created an impairment provision for the loan and equity invested in our Dutch entity VCH for our four-wheeler lighting operations, which we divested. We have now written off the loans in Q3 as we have completed the FEMA-related compliances for write-off with December 1st, 2023 as the effective date. This is well supported by opinions from two independent senior legal counsels also. As a result, the profit after tax was much higher due to recognition of the tax benefit from the aforesaid write-off. We continue to have strong order wins from our customers in the 9 months of FY24. Our customers continue to trust us with sustainability for their new products. In 9 months of financial year 24, our new lifetime order wins is rupees 67.57 billion and on an annualized basis, rupees 11.99 billion. In Q3 of FY24, our existing customers in the EV space have given us further opportunities as the market continues to evolve. These new orders will enable us to increase our revenue better than industry, as the content remains 5 to 6 times higher than supplying to the IC variants. Our revenue from supplying to EV vehicles in Q3 of FY24 was approximately 5.3% of our overall revenue against 4.4% last quarter. Now, I will ask MK, our Group CFO, who will walk you through the presentation, which is already uploaded on our website and submitted to stock exchanges also. Over to you.
Thank you, Tarang. Good evening, everyone. I'll first take you to the highlights slide, which is slide number 4. So, as Tarang mentioned, the year-over-year revenue growth was 9.4% in Q3. India operations grew by a strong 20.1%. This is in line with what we have been saying all along about India operations. However, we had some challenges in the overseas businesses, largely impacted by degrowth in certain markets in Europe, and also because of lower offtake by major customers. So the customer concentration is also a factor which impacted us this quarter. However, we have been working on action plans to achieve gradual revival, and we are hopeful of seeing gradual revival over the medium term with various actions put in place. Coming to revenue from EV customers, it was close to 5.3% during Q3. It is also helped by strong performance from some of the key customers in the EV segment. Coming to profitability, the EBITDA margin was slightly lower this time at 9.2% compared to close to 10% that we reported in the last 2 quarters. But this was again the impact due to the impact of the overseas dip in growth and revenue. So the absolute EBITDA during Q3 was about 173 crores, with PBT margin close to 3.7%, which is still higher compared to last year by about 3%. As our CMD mentioned, PAT was also helped largely by the deferred tax asset creation for the write-off of loans, which we actually gave to the divested entities last year in the earlier years. We created provision last year, which is what we converted into write-off. I'll explain about this in greater detail in the subsequent slides. In terms of lifetime business one, in the 9 months, it was close to 67 billion, with annual peak revenue potential of close to 12 billion INR. Coming to the industry numbers, year-over-year business growth was good for all the industry segments. The two-wheelers grew by 19%, three-wheelers by 13.4%. Passenger vehicles and commercial vehicles also grew by around 5 to 5.9%. However, interestingly or unfortunately, the quarter-over-quarter saw a degrowth in all the segments. Two-wheeler had a degrowth of 1.5%, three-wheeler 8.9%. Passenger vehicles also went down by 11%, so that's something to be noted. On 9-month basis also, most of the segments, in fact all the segments registered either single-digit or double-digit growth. Two-wheeler grew by almost 6% or 5.7%, three-wheeler by close to 19%, and passenger vehicle by close to 6%. Now going to slide number 6, where we show the consolidated financials. The Q3 PBT was 3.7%. And then of course EBITDA was 9.2%. Revenue growth, of course, we explained. PAT also we will discuss subsequently. There was an increase in net debt also, which I will explain in the subsequent slides. Looking at the 9-month performance, the total 9-month PBT was coming to 3.7%, EBITDA at 9.7%. But if you really look at the cumulative year-over-year growth in 9 months, the revenue grew by close to 7.4%. EBITDA grew by 24% and PBT by almost 400+%. Moving to the next slide, this is where we are talking about the net debt number. As you may recollect, in the last investor call, we mentioned that the net debt was pretty close to 1,000 crores. It was at 1,006. This quarter, it actually went up marginally to 1,062 crores. There's an increase of about 56 crores. This was largely because of various reasons. One, we also invested in renewable energy, like how we explained earlier. This was meant to achieve cost reductions, which will help us in the next year. And there were certain final payments to be made to the divestment-related consultants, which is what we completed during this quarter. There was also a temporary increase in working capital because we had to correct some of the GST rates on certain parts. So there was some time lag between the payment to GST authorities and the collection from the customers. A major part of that has now been collected. Part of it was done in Q3, and a significant part was also collected in subsequent to Q3 in the current month. We are hopeful of collecting everything this quarter, so that should actually correct the temporary mismatch in the working capital. There are also certain arbitration costs relating to China JV, which we had to pay during the previous quarter. So because of this, there was an increase in net debt. We are hoping that this should get corrected in the coming quarters. So because of this, and also helped by the recognition of deferred tax asset and the improvement in net worth, the net debt to equity is now pretty comfortable at 0.7. Net debt to EBITDA is also below 1.5. Return on capital employed, of course, had the impact both on the numerator and denominator. Numerator because of the lower earnings, and denominator, of course, now the capital employed is more because of the net worth addition which happened because of the tax benefit. So going to slide number 9. So this is where we explained the logic behind the write-up of loan. We actually consulted a couple of eminent legal experts. We took opinion from Mr. Arvind Datar and Mr. Ajay Vora, who represent Weiss Associates. We have been working on this for some time now. We collected a lot of evidence to basically justify our case for opinion. We also consulted our authorized dealer to basically complete the formalities in relation to FEMA regulations. So we could complete all this, and based on this, we actually took this benefit in Q3. So the underlying logic was like these investments which we made in the overseas entities were more in the nature of trade investments. These were not made just for the sake of earning dividends or capital gains. So that was the major underlying logic. And similarly, the Indian operations also benefited significantly in the past due to a technology sharing between four-wheeler lighting and two-wheeler lighting operations. We also derived benefits from supply chain support and also the access to global OEMs and their India operations helped the Indian businesses. In addition to that, the guarantee commission interest earned on those loans, they were actually offered to taxation in India in the earlier periods. So that is also another reason why we think we can actually claim this deduction in India. And one more thing is the divestment. Of course, all of you know the kind of challenges we had at the time of divestment, including the macroeconomic scenario. So in a way, the divestment of these businesses also helped safeguarding the interest of India business. So considering all this, the legal experts felt that we have a good case for claiming this deduction. So based on that, we went ahead and recognized this benefit. Coming to slide number 10, which is about the revenue breakdown. The strong performance in India and of course the growth in the overseas businesses changed the business mix in respect to segments. The lighting business, of course, is now at close to 21%. It used to be close to 25% earlier. Similarly, the outside India business also shrunk now to about close to 14%, which used to be about 18-19% earlier. And the strong EV performance also resulted in Bajaj's percentage going to 44% compared to 40% earlier. In terms of new lifetime order wins, in the 9 months, we have close to 67 billion of order wins. If you really look at the breakup, Bajaj related order wins was close to 54%. And then interestingly, the EV percentage of the total lifetime revenue is now close to 50%, so which is a strong sign for our future growth. So then we have also certain awards which we won in different segments of the business. So let me close with this, and now we can take some questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity. Sir, you have one-time tax reversal and write-off of loans of around
Abhishek, sorry to interrupt. Your voice is a bit disturbed.
Are you able to hear me right now?
Yeah, we can. Please go ahead.
Yeah. So, as there's a one-time tax reversal and write-off of loans of around 2.96 billion, will be flow into our balance sheet? So just wanted to understand what is the impact on the BS and the cash flow of this particular write-off and tax reversal.
See, if I understood your question correctly, you want to know the impact on balance sheet and cash flow. Am I right?
Yeah.
Yeah, in terms of balance sheet, this will boost the net worth because to the extent of improvement in PAT, it will result in improvement in net worth. And then, of course, it will also result in creation of deferred tax asset on the asset side. Coming to cash flow, yeah, that's the whole intention is to save cash. So that's why we are going for this.
So post this transactions, what would be the cash in our books?
Yeah, see, this is basically about write-off of 1,350 crores. So we'll be switching over to the new tax regime where the effective tax rate comes to about close to 25%. So then you can compute the benefit, which will spread over the next 2 to 3 years based on how we grow our profits.
So next 3 years, our effective tax rate would be around 0 to 10% or range, or what would be?
Sorry, voice is breaking.
So in the next 3 years, what would be the effective tax rate, sir?
See, that's what. Switching over to the new regime, but effectively our intention is not to pay actually tax in terms of cash flow for the next 2 to 3 years.
Okay, so the benefit will be flow for the next 3 years in terms of the tax benefit, right?
Correct.
And next question on the non-Bajaj business, we have seen a flat growth in 9 months FY24. So how do you see growth ahead? Because you have won many business and around more than 50% of order intake is done non-Bajaj segment. So what would be the key trigger?
Mr. Abhishek, your voice is breaking too much. We can't hear you.
But okay, we have a little bit understood the question, so I can. Okay, you can repeat it once more.
So, sir, in non-Bajaj segment, we have seen flat growth in 9 months FY24. So, with the key triggers for when that you have very strong order backlog in non-Bajaj segment.
So basically, see, if you really look at our business wins, for the 9 months, which is, almost 1,200 crores, out of this, 54% is Bajaj. And it's also largely because of a lot of the businesses we won with high content, like EV and clusters and lighting. But the other 46% is actually non-Bajaj, which is also quite significant, which is also close to, almost 550 crores. So we are actually growing our business wins also with other customers. And whether it's on the two-wheeler side, our focus, of course, we have said always is that one is that for whatever the products we do today, including our traditional products, we are focusing on capacity utilization. And of course, this capacity utilization is not only coming from Bajaj Auto, it's coming from, with two-wheelers coming from all the other customers, two-wheeler OEMs in India. And on the four-wheeler side also, our focus is on the plastics and also on the lighting business, where also we are kind of winning business, and we are also kind of utilizing, those capacities. But yes, going forward, I think we have seen a lot of good interest, from all the OEMs and also a few new startups, prominent startups on our EV powertrain products, and we had reported actually a couple of wins on the EV powertrain in the last quarter, and we are strongly engaged with a few other two-wheeler OEMs, also, and we are hoping that in the coming months or coming quarters, we will succeed in winning some more, business when it comes to EV powertrain. And when it comes to products like lighting and also the instrument clusters, that's something, we are anyway actually driving higher and higher sales. And so basically whatever is the, the content based, which is more to do with electronics and EV, we are very well engaged with customers and we are winning businesses. So I would like to say that when it comes to the India story, it's very much intact and growth oriented. Even if you see, our growth, in Q3, our India operations has grown 20% year on year versus 15% for the overall industry. And even in the 9 months, we have grown 11%, as against 6% of the industry growth. So we have actually been, we have been actually growing quite well, I would say, when it comes to, the markets. And yes, Bajaj, yes, is our major customer, and whatever we can do with Bajaj, we will do. But it doesn't mean that our efforts are not on with all the other OEMs. And going forward, you will see that, we have won some very interesting business with the other OEMs as well, two-wheeler and four-wheeler.
Okay, sir. And overseas business.
Sorry to interrupt, sir. May we request you to rejoin the question queue, as there are several participants waiting for their turns.
Okay, thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Prateek Poddar from Nippon AMC. Please go ahead.
Yeah, hi. Here a couple of questions. One is, you've won 3,000 crores of orders this quarter, right? That's a fair understanding?
I'm sorry, we couldn't hear you well, I'm sorry, can you just repeat it?
Am I audible? Hello?
Yes, now we can hear you.
Okay, I was saying you have won 3,000 crores of orders this quarter, right? Is that a fair understanding?
Yes.
Okay. The second question is, when I look at FY25, I'm on slide number 10, you say start of production from FY25 is around 4,600 crores. What is the average life of these orders, in the sense, in how many years or when does this peak out?
That's what in the initial speech also CMD spoke about, that the peak annual revenue of this is around 1,199 crores.
Yeah. And by when do you hit that?
So,
like when do you achieve this?
So Pratik, the peaks will take place over different years, right? It depends on multiple factors, but primarily also when the OEM will SOP, and really when the OEM would SOP. But you could expect, whenever an order win is declared, you could expect SOPs generally within, let's say, 12 to, at worst case, 30 months.
So here what happens, I'll tell you, is that, see, when it comes to the two-wheeler market, normally, you normally is much faster, the development cycle. So there, I think it could be within a year also. But when it comes to the four-wheeler segment, there it could even go up to, 1.5 to 2 years, because that's the way, the order wins are. And for four-wheelers, normally, they take a longer time on the development compared to the two-wheeler. So that's the reason that, we are giving, the lifetime, and we are also saying annualized basis. But on the annualized basis also, you're right. I mean, two-wheeler and four-wheeler, if you break it up, I think how much is the four-wheeler out of the total business win?
16.6%. 1124 crores.
That is a lifetime order win. Out of that, around 16, 17.
16.6%. Yes, there in your presentation, slide 10.
Yeah, so 16
to 17%.
So 6 to 17% would be more the four-wheeler business win in this, and rest would be more the two and three-wheeler.
Which would ramp up fast, right? As you just explained, within 12 to 18 months. Okay. The second question was on your China JV. I just seen, the PAT has increased sequentially quite strong. Could you just explain this?
Yeah, so this is largely helped by the revenue growth as well as the margin improvement. There were certain retro price increases also which happened. So all this enabled us to show a decent profit growth.
Is this sustainable, sir, going forward also, the 25 crores kind of run rate?
So normally what we see in the Chinese market, see for them it's more of a calendar year. So the last quarter is always fairly strong, and then that would mean like Jan to March would be Q1 for them. But because of Chinese New Year, obviously the sales and the sales would be less in the first quarter.
Which is fourth quarter for us.
Which is for us the fourth quarter. So, but having said that, yes, it's not that the Chinese market, the sales, obviously you can see the market has not really been growing that well compared to the earlier years. But where we are concerned going forward, I think that we have had some very interesting business wins. So we are looking at a decent growth in the coming year and years. So it will be more like, more of, increase in our market share in the Chinese market. But the growth, of course, is not more than 5%, in the Chinese market presently.
Understood. That's very helpful. The third question was, sir, on your other expenses. I think we have been highlighting about, reducing our fixed costs and that's an exercise which has started from maybe start of this financial year. But I mean, as of now, I can't see any improvement. So how should I think about reducing your fixed costs?
Yeah, see, it's other expenses are not entirely fixed cost, as you know. It has certain variable cost elements also. In fact, a significant part of that is variable cost, including your fuel, freight, packing cost, all these other. But having said that, some of the one-time fixed costs also we had to pick up. Like I was explaining earlier that the arbitration-related cost and all we had to actually pick up. So those things are more like one-timers. They are not sustainable or continuing fixed cost. So that should get corrected in the coming quarters.
Can you call that out? How much would be the arbitration costs or the one-time fixed costs which were picked up this quarter?
For example, it is close to about 10 crores, 8 to 10 crores.
Okay. Got it. You also talked about in your presentation about, lowering of electricity costs by investing in renewable energy. And our understanding was that should have started reflecting from quarter 3. So is there been a delay over there or it's already getting reflected?
No, it was not quarter 3. It was always scheduled for actually March kind of commissioning around March.
Okay.
But we should start seeing the benefit, if not from April, at least from May onwards.
And how much can this help us by?
I don't want to give those micro level details, but yeah.
Okay, fair.
Numbers are quite interesting. Yeah.
Sorry, sir. The numbers will be?
It will be quite interesting, for you. We don't want to let you know at the moment. I think let us first realize those numbers, which we feel should probably materialize more from the month of May.
And also it will come in phases. It's not just a one-time kind of. There is more to do in this area also, but it will happen over a period of time.
Got it. So the other is with this creation of deferred tax asset, obviously the cash which you save, does that mean that the repayment of debt will be quite fast in the sense, let's say earlier if you were planning in 2 years with virtually no tax payments for the next 3 years, the cash savings, we can assume a very fast debt repayment and maybe by the end of next financial year, we could be very close to net debt, zero net debt or.
I want to give a future prediction, but yeah, that's the objective. The objective of this is to conserve cash.
Okay. And just small bookkeeping question. We have seen a sharp increase in depreciation and the idea was always capex to be lower than depreciation. Are there one-offs over here also which you are writing it off?
It's not because of additional, I would say, capex related depreciation, but it's somewhat related to that. we have we commissioned a new plant in Chakan here in Pune. So it was a leased facility, so the lease depreciation and interest are accounted in both depreciation as well as interest. So that's the reason.
This is despite us running at 70% capacity utilization. So which
Sorry to
segment?
interrupt, sir. I would request you to rejoin.
Sure. Yeah.
Thank you. Thank you. We have our next question from the line of Naveen Baid from Nuvama Asset Management. Please go ahead.
Thank you for the opportunity. The speaker before me was just confirming whether the order wins for the quarter were to the tune of 3,000 crores. If I look at the order wins for the past 2 quarters, which is for the 9 months, that is, if I look at the order wins for the past 2 quarters, they are roughly 4,700 odd crores. And for 9 months, it is 67 odd crores. So the numbers are not adding up. So this quarter's order win are likely to be 2,000 crores and not 3,000 crores. Is that correct?
This quarter, the order win has been around 3,000 crores.
But he's saying it's not adding up compared to the first 2 quarters.
Or has there been some cancellation? Like, how do you explain that?
No. The 6-month number was around 3,900. 3,900 odd, and this quarter also it's closer to 3,000 crores.
Not exactly 3,000, it's slightly below 3,000, but
yeah.
Okay, and this 6,700 obviously includes the order win from the EV side.
Yes.
Okay. What's been the gross margin this quarter?
Sorry?
The
gross margins?
Gross margins on these orders?
No. What's the gross margin this quarter?
Oh, that we can compute. No, it's around 36.
Yeah, it's around 36.3%.
36.3.
Thank you.
Thank you very much. We have our next question from the line of Jyoti Singh from Arihant Capital Markets. Please go ahead.
Yeah, thank you for the opportunity. Sir, my question is on the debt side. Like earlier quarter, we have committed, like we will going to reduce our debt, but now it increased in this quarter. So, like, what are the objectives going forward on the debt side?
No, like how I explained in the earlier presentation, it was part of it was because of some temporary reasons, because of the working capital mismatch which we had. It should actually go down from hereafter. That's our intention. So the objective is still intact. We are very much working on debt reduction.
Okay. And sir, any target that we are keeping for the debt reduction that we can disclose with?
We don't want to give a number to it, but like what we said, there is no reason for us to borrow more for any of our business requirements. So whatever cash that gets generated out of business will only go to reduce the debt.
Okay, thank you, sir. And sir, earlier also we commented that H2 will be stronger, but somehow Q2 quarter and quarter, not that great. So what are the expectations for Q4?
You're talking about the top line or bottom?
Overall, sir, I'm talking about margin and top line.
Yeah, we don't give any guidance like that, but yeah, I mean, normally Q4 industry should be reasonably well, so that should also reflect in our performance. But then, like how our CMD explained, recovery in overseas segments will take some time.
Okay, thank you, sir.
Yeah.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Tirth Gosar from Swan Investments. Please go ahead.
Thank you for taking my question, sir. Sir, I have a couple of questions. My first question is relating our growth. So we have seen, yes, quarter on quarter, almost all segments have seen a slip. Two-wheeler has seen a lot, a better performance than other segment. And in fact, if you see, EV two-wheelers have seen a growth across all your, customer category. So can you explain, and we have gained some good order book also over a period, plus we also dwell upon that our content per vehicle or value per vehicle have also increased increasingly with every new order. So can you explain why, quarter on quarter, the growth is being muted, and what is going ahead? How do you see this movement ahead in next 3-4 quarters going ahead?
So I think it was more to do, with the season and everything, because of the degrowth in all segments. So the way we see quarter on quarter, the industry, I'm talking about India now, in industry degrew 3%, but we grew 3%. And we've always maintained that we are going to be at least 4, 5, 6% more than the industry. So that is intact. And I think that today the auto market is still doing quite well, and I don't see a reason why it will not continue to grow. By what percentage, I don't know. But I think the growth story definitely is intact in India across segments, even for commercial vehicles, because our GDP growth is this thing quite good. So I don't really see any kind of a issue really in future growth when it comes to the Indian market. We are quite bullish, and like I said earlier, we're very well engaged with all the customers on the two-wheeler and on the four-wheeler side, and we feel pretty confident.
My second question is, what do you expect your tax outflow percentage as we are moving towards the new regime for the next financial year?
No, we don't give any forward-looking guidance like that. All that we can say is, our intention is to conserve cash by taking this benefit, but we don't give guidance on future profits.
Okay. Sir, any regarding our China JV plan, arbitration which was there, how is it moving forward? Are there any positive news there?
So there is an arbitration on in Singapore with the partners. In between, we have been trying to have a split with the partner. As you know, that there are 2 plants and 2 entities. We are trying to go in for a split, but so far we've not been successful. I think the order on the arbitration probably will come in probably by July, by H1. So then we will probably know what the result is. We don't know what will really happen, over here. Probably one partner buys the other, or in between there is a kind of conditions get created for a split. So it all depends on the tribunal. So at the moment we don't know, but largely I would say all the arguments and all on this in Singapore are basically largely done. There's probably one more, I think, hearing probably in the month of May or June, and after that I think probably there will be that decision taken. So we'll come to know probably in the first half of FY25. We will know, the result of this JV.
Okay, sir. Sir, what was the capex in the first 9 months, and what is the capex expected for FY24 and 25?
Yeah, first 9 months we spent about 125 crores. We may finally close the year with about 160, 170 kind of. This is for India operations. Maybe another 20 crores for overseas. So close to about 180 could be the number.
Okay. And sir, 25?
It could be around this range only. We don't intend to take it beyond 200 crores.
Okay. Thank you. That's all from my side, sir. Thank you and all the best.
Thank you.
Thank you, sir. We have our next question from the line of Arvind Sharma from Citi. Please go ahead.
Yeah, hi. Good evening, sir. Thank you for taking my question. Sir, first question would be on the PLI incentives. If you could share any views there. Is there any accrual happening, or when do you expect that? I have a second question on order books, but first your views on PLI.
So we've not accrued anything for PLI yet, but for certain product lines we would expect to soon.
All right, sir. The second question would be on the order wins. We see the lifetime order of around 67.5 billion that we've given. Are all these new orders, or how many of them would be fresh orders? And since you've shared the FY24 and FY25 onward split, is it possible to share till when, what's the order life, or what's the time when these will fructify?
Okay, so I'll go one by one. This will be a combination of new programs as well as volume expansions on existing programs, right? Or let me not necessarily call them existing programs, but volume expansions where there is modifications in the programs. So if we have declared X volume as an order win in the past, and there's an expansion to that, that will obviously come, that delta differential will come in what we report now. That's one. The second one was in terms of the SOP expectation. I think we've already shared some information around when we expect SOPs to take place, right?
Yeah, FY25 onwards, he's saying for how long it will continue.
So directionally, like we said, right? I think it depends lots of times on it depends on customers as well, right? So two-wheelers are generally a faster cycle, passenger cars are generally a longer cycle, but I mean, they would generally take place within 12 to 30 months.
12 to 30 months.
Yeah.
All right. Okay. Great. Thank you so much, sir. That's all from my side.
Sorry,
Thank
12
you.
to 30 months, not from now, but from the actual order win.
Yeah, fine. Fine. Thank you.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. We have our next question from the line of Prateek Podar from Nippon AMC. Please go ahead. Mr. Prateek, are you there?
Sorry, I was on mute. My apologies. Am I audible?
Yes.
Yeah, sorry. Just profitability of these new orders, right? You've won close to 5,000 odd crores of orders, maybe slightly lower than that in the last 6 months. The profitability, could you just comment on it? How should we think about it? Is it higher? Is it lower? Because the mix is quite interesting, right, in terms of EV players versus ICE. So just trying to think about the profitability of these orders.
So I would see, it's hard to comment on profitability specifically because every product line tends to have different product economics, right? Really based on manufacturing processes, engineering intensity, overhead intensity. So the way I would describe it is sustainable profitability, right? We have strong internal thresholds based on which we quote, and that is what we respect.
Understood. And just one small question, and I'm just going back to what even I was asking earlier in terms of the ramp up. You know, the way you are explaining that it takes 12 to 30 months from the start of production for the orders to ramp up, looks like FY25 and maybe FY26, where we realize bulk of this 5,000 crores of new order wins in the last 6 months, it could be quite substantial. So we could see a far higher outperformance over industry growth over the next 2 years versus what we would have seen in the past. This is just the order book which we have just gathered. That's a fair understanding?
Yes. It is. I mean, for sure. I mean, that's our intention, and we are hoping that whatever other SOP dates the customers have told us, if they get realized, yes, I think it will keep with our objective of actually growing faster than the market. If a lot of these products are also high in content, and next year, we had mentioned probably in one of our earlier calls that our revenue towards EV, we would like it to be 1,000 crores, and that is there's a very good possibility of achieving that in the next financial year.
Understood. Thanks for this, and best wishes for the future. Thank you.
Thank you, sir. We have our next question from the line of Mr. Abhishek from Dolat Capital. Please go ahead.
Sir, what was the operating margin ex overseas business?
No, we don't give those sub-segment level details.
So what is the margin for the domestic business right now?
No, sorry. We don't share that.
But see, we told you that 85% of our, revenues were from India.
Yes. And sir, this overseas businesses continue to be a drag from last many.
Sorry, voice is breaking. Please repeat it.
So this is always a drag for the company finances. Can we expect some more right in the companies?
No, we can't hear you. Sorry.
Are you able to hear me, sir?
We can't hear.
It's
what
not
you're
very
saying.
clear for some reason.
Sorry, sir, we can't hear you.
Are you able to hear me right now?
Yeah, please go ahead.
Now it's better.
Yeah. So my question was related with this overseas business. Basically, that was a drag for the company's finances. So can we expect some more write-off in the coming days?
No, we don't see any need for write-off. In fact, our intention is to actually improve profitability and also growth in all these overseas markets. So we don't see any need for any kind of write-off at this stage.
So how you will achieve the 10% kind of the margin target, as there will be continue to be a pressure because of these business. So what is your plan for that, to achieving 10% or 11% kind of the operating margin?
So, like our CMD already said, right? We work on de-risking the customer base. We have already made moves towards insourcing and hence improving, let's say, some of the material margins. And also we work, given that supply chains globally are slightly better, especially from a semiconductor standpoint, we work on working capital optimization also, right? So
plus we continue to work on cost reductions across our businesses.
Yeah.
Okay. And my last question on the electronic business unit, where we have seen a 15% growth in 9 months. So how much is incremental revenue from the EV business in this year? And what would be the target for the next year?
See, like what we explained at the total level, EV revenue is about 5% of the total, 5.3%, and last year I think it was pretty negligible. So the entire thing is incremental.
Okay, sir. Thank you, sir. That's
Percentage will grow as we move forward.
Thank you, sir. That's all from my side.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Mr. Ashin Modi from Equirus Capital. Please go ahead.
Yeah, thanks for the opportunity. So my first question is regarding the India lighting business. So it's a very fast growing segment and with a lot of premiumization happening across. So how do we see that business growing, and with competition intensity increasing over here, how do we see that business growing? Because 9-month performance has not been that strong in that business.
So I think when you read the 9-month performance, that is our global lighting performance as including India, of course, as a percentage of our total sale. Right now, of course, like we have talked about, you will see, I mean, and as you also see, right, overseas is reduced as a percentage, so that obviously impacts lighting as well. But in India, we don't see any roadblocks to lighting growth at all. In fact, our lighting business in India continues to do well, and that is largely driven, like we said before, right, by the fact that we have been a very early mover, if not first mover, especially when it comes to LED lighting. So we continue to have program wins. We continue to see volume expansions, whether in two-wheeler, whether in passenger car, and we expect that trend will continue.
Sure, sir. Sure. And then my next question is regarding the EV specific components. So, have we added any new products over there, and where are we on the journey of adding other OEMs for our EV specific products?
So today, practically in the product range that we already address and we already market, I don't think we want to add any products beyond that. In fact, we're clear we will not add products beyond that. Like we stated last quarter, we were able to add two further EV customers for EV specific components, and we will see those realizations. We will see those realizations over the next, the next 12 to 18 months. Of course, these components, I mean, essentially when you are trying to supply the EV powertrain, it's extremely engineering intensive component and is also a very long sourcing timeline kind of component. So we continue to have strong engagement with multiple other customers, And yeah, hopefully we should have over the coming quarters, we should have more to report.
And are we, do we have enough capacity to, have the growth that our major customer is seeing on the EV side, or do we need to put in more capacity for the EV specific component?
So I think we've already given visibility around what our total capex numbers would be limited to, and within those numbers, we are able to support any expansion the customer would like.
Yes, sure. Thank you. I'll join back to you.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. We have a next question from the line of Priya Ranjan from HDFC AMC. Please go ahead.
Yeah, hi, thanks. Just a couple of questions. One is on this, the EBITDA margin. If I look at the quarter-on-quarter, the volume top line was flat. Still, there has been 60 basis points. So, is it largely because of mix, or there is something more to it?
Yeah, it's largely driven by these challenges we had in the overseas market, so that had an impact.
Okay, so overseas have higher margins, so that's why. And where is this 10 crore arbitration charges is booked? Is it part of the other expenses, or it's capital?
Yeah, correct.
So that explains the 10. Because if I do the 10 crore in the EBITDA, then I think 40-50 basis point impact is because of that, right?
No, see, there was arbitration expense in the previous quarters also. It's not that it was zero earlier. It was maybe to a smaller extent. So last quarter, it was close to 10 crores. Arbitration plus a couple of other consultancy related expenses.
And this is going to continue for a couple of quarters, or this will now, because I think most of the hearing is done, so what is...
Correct. It should not be to this extent is our expectation, because like what you said, most of the arbitration hearings have been completed. But it will come down gradually. Yeah.
Okay. And in terms of overall capacity utilization of different plants, if you can throw some light on what are our operating capacity utilization and how much benefit, as we enter next year with a very good order book and the order ramp up. So should we expect meaningful operating utilization level in the going forward, I think FY25-26?
Yeah, so I think like we stated in the past, I would, our blended capacity utilization, because of course we operate multiple different processes, would be around 65%, some places maybe around 70%. But again, right, I think we have the order book, we have defined what our capex outlook is for this year and also for next year. And within that, we believe we should definitely be able to execute the order book. Now, of course, that will also lead to an improvement in capacity utilization.
And as we move towards the greener energy, so what is our plan? So how much greener energy in terms of our internal utilization? What should be the percentage share from that?
With the proposed one which is under implementation, we should be somewhere between 35 to 40% in terms of the overall sourcing from renewable energy.
Okay, and this will be supplied back to the grid and then whenever you require, so you can utilize it from the grid.
Yeah, we'll get billed for the net amount.
Okay.
Net amount of consumption.
Understood. And in terms of your the cash conversion to EBITDA, that has been not so strong. So any specific reason is, I think the only working capital related issues is there, because your EBITDA was, I think, 175 crore, 73 crore this quarter. I guess with around 40 odd crore will be primarily driven to the capex. So whereas
You're right. I think I also explained it earlier in the slides. The temporary working capital challenges this quarter created that kind of disparity. But if you see the earlier quarters, it was coming out nicely.
Okay.
Quarter on quarter is better cash conversion. You should look for a longer period. So 9 months, the numbers looks good.
Okay. Okay, thank you. All the best.
Thank you.
Thank you, sir. We have a follow-up question from the line of Prateek Poddar from Nippon AMC. Please go ahead.
Sir, maybe if you could just spend some time explaining us as to the overseas operations. We have seen a very, very sharp decline, let's say if I were to see from quarter one. How should we think about its recovery? I know you have explained it in bits and parts, but the risk mitigation, I mean, the customer concentration risk which we have seen, and you're trying to mitigate that. How should we think about this business in the next 2-3 years or maybe next 12 months?
So, there abroad, the major area for us is Europe, and of course we have also Vietnam. So, here the issues have been largely to do with the European market, where we are concerned, whether it's to do with two-wheeler or whether it's to do with, the electronic products. And of course, this has been a little bit compounded by concentration on a few customers, and basically what has happened is that when it comes to two-wheelers, our focus has been more on scooters, and where scooters have actually degrown more than the motorcycles, in that segment. So what we are doing is that now we are also winning businesses on the motorcycle front, where it comes to Europe, and also where it comes to our Vietnam plant, the focus is now going to be much more with the Japanese OEMs. Today the concentration is more actually with some of the European OEMs, even in that market. Yes, we have Japanese customers, but now we would like that we are focusing more, with the Japanese OEMs, and we also strengthened, our sales, our sales team, in, both in, also in, I mean, also for Southeast Asia. We already have our office in Japan, which is also closely working on seeing that a lot of these businesses, this thing, are really converted, into orders for us. So there's a lot of focus where it comes to more, I would say, Southeast Asia, and when it comes to Europe, yes, the growth there, will not be as high as Southeast Asia when it comes to two-wheeler. But when it comes to electronics, a plant in Romania, that's where we are looking at, we are really focused on winning new businesses, over there. So one is, of course, the focus on, sales wins, on the overseas. The other is what we have done is that, which includes China and also in Vietnam, that we have, we were so far, though our margins were quite okay, I would say across the distinct product lines, but we didn't have our own electronics, so far, when it comes to two-wheeler products, or the four-wheeler lighting in China. So now we have installed, our own SMT to the extent of at least, when it comes to two-wheeler, I think it'll be almost 100%. When it comes to four-wheeler, it'll be 30 to 40%. So this will also, increase margins to the extent of at least 3-4%. So this is one, big step. So one is sales growth, utilization of capacities there, which we have seen, in the last quarter go down, and which will be impacted for the next few quarters also. But we are working very proactively on sales wins, which probably, should happen probably, let's say within a year's time, that we'll see that growth, this thing taking place. On the other hand, cost controls, and mainly on the BOM side, SMT. In-house SMT is what is going to drive margins up, which will help the overall situation of our business division, abroad.
This is it, sir. Thanks. Sir.
Thank you. Ladies and gentlemen, that was the last question for the day, and I would now like to hand the conference over to management for closing comments.
So thank you very much. So I just want to kind of say that the focus of the company remains to further strengthen the Indian operations, bringing back the profitability in our overseas operations, control on overall capex, and generation of free cash flow and reduction in net debt. So with this, thank you for joining the call, and we'll again meet soon after one quarter. Thank you.
Thank you.
On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.